What's up guys, it's Sunmin and welcome back to Your Money Game, the show where we get better with saving, spending and investing. And today, we're taking a dive right back into the world of robo-advisors, especially for those of you who are new to investing. Months ago, I've already covered the subject of whether or not somebody should consider using a robo-advisor to invest. Since then, I realized that many were interested, but then had trouble choosing between them. Hence this video, which will help new investors figure out how to evaluate between these different players. I'll start by going through a quick explanation of some of the common terms used by these robo-advisors. Then I'll move on to help you understand their products, how they charge you and the kind of fees that you pay. And finally, I'll end off with some advice on how you can manage your robo-advisor. So if you're ready, let's go. So let's start with those common terms. Since it's impossible to know your exact starting point, I'm going to make some very basic assumptions. Firstly, you've heard of what a stock is. You might have heard of what an ETF or unit trusts are, and you might have heard of this term called portfolio, which is basically a basket of stuff. So with that out of the way, let's talk about some of the common terms that are used by all these robo-advisors when you're marketing to you. The first term is risk profile. Now, some robo-advisors try and help you figure out what that risk profile is. All it simply means is what are you able to tolerate on the downside when it comes to volatility of the prices. To give you a tangible example, say you have a portfolio value of about $1,000 and your risk profile is about 10%. So 10% is about $100, right?
Wow.
So what happens is that in the majority of times, your portfolio value should not dip below $900. Now, it's important for you to understand that that limit isn't a guarantee. It is simply a high probability in a given year that your portfolio value will not dip below that risk profile percentage. The next popular term is asset allocation. So asset simply refers to the different types of investments available out there. So for example, stock is considered a type of asset, real estate, bonds, cash, and commodities like gold. The term allocation simply means how are they mixing and matching all the different things to try and build that portfolio to suit your risk profile. So for example, stocks are considered really high risk, whereas bonds less so. So when they start to combine it in a ratio, say 80%, 20%, that is what your asset allocation looks like. And the entire purpose of this is to try and balance that portfolio's risk and return. The next term they like to use is rebalancing. So remember that asset allocation I mentioned earlier? Say it's 80% stocks, 20% bonds. Let's say your stocks do very well and suddenly your ratio shifts. The value of your portfolio suddenly becomes 90-10. 90% of the value came from stocks, where 10% came from the bonds. Now, under that situation, it can be very risky for you because suddenly the 90-10 ratio doesn't really suit your risk profile. So that's why with the term rebalancing, the system simply sells off more stocks, buys more bonds to get back to the original ratio of 80-20. So on the surface, all robo-advisors try and help you invest easily, but once you kind of look under the hood, they actually differ quite greatly. First of all, they're all going to offer you a digital platform. So unlike banks, you don't have a branch that you can walk into, so you're going to have to be comfortable with the idea of using digital means to get in touch with them. While all of them offer you a range of different portfolios, some of them also offer advisory services. It's a pretty cool option to have, especially if you have a bit more of a complex financial life and there's some advisor that you can kind of get in touch with either through phone or maybe through message. Next, as you're evaluating them, you'll realize that all of them allow you to invest cash, but not all of them will allow you to invest stuff like SRS, and the only one available in the market now that can invest your CPF money is Endowus. Now this might matter to some of you who just don't want the hassle of managing multiple robo-advisors. Now, getting into the actual products they have, this is where they differ the most. To try and simplify things for you, the question you need to ask yourself is, do I need help in building a total portfolio with many different assets? Or do I want to kind of pick and choose for myself? In another way, you could also think of this as if you want a happy meal where everything is made for you and you just buy that one thing, or do you want a la carte menu where you can pick and choose different things to build your own kind of portfolio. A Happy Meal example is kind of like Stashaway. When you identify your risk profile, you choose that index, they kind of build that portfolio for you, which you can't really mess with. An a la carte menu is kind of like OCBC's robo-invest, which is where you build your own portfolio out of like 32 different options. As to what they invest in, some robo-advisors will use ETFs, some will use unit trusts, and some will actually buy the individual stocks to build that portfolio for you. Now, while there are technical differences and some cost implications behind them, I think this is an area where a beginner shouldn't fuss about too much. What you can fuss about is my like and subscribe button so you can help my videos reach more people. Now, since I mentioned costs earlier, let's dive into that, all those things that are related to money. Starting with fees, the headline rate, which is usually what they advertise at you, is the first thing that we tend to see. And that's very straightforward in a sense that they charge you that percentage of the total amount of money that you invest with them. It tends to be calculated on a daily basis and then charged to you either on a monthly or a quarterly basis. The other layer of fees are usually what's charged by the underlying ETFs or unit trusts. Just remember that the job of the robo-advisor is to build that portfolio. So if that portfolio includes ETFs and unit trusts, they are individually managed by its own team. So naturally there's a fee associated with that, but you do not see that reflected in your statements. It is usually deducted at that level, and by the time you get your own statement from a robo-advisor, it is just their single fee which is deducted. All you need to know is that these charges are unavoidable for robo-advisors who are using ETFs and unit trusts. Again, what they tend to promise you is they'll use low-cost ones so you don't incur too much cost in that area. There's a range of other small little hidden costs as well, for example like foreign exchange. But it honestly does get very detailed, and a post by Endowers kind of outlines some of it. The problem is, it is extremely difficult for a layman like you and me to go and verify these things. Look, don't get me wrong, costs and fees do matter. But I think for beginners, it is something that you shouldn't really be worrying yourself too much, especially if your invested sum is quite low. So imagine for a beginner, your cost differences are 0.2 or 0.4 between two different robo-advisors. In the bigger scheme of things, if your portfolio's value is about $10,000, that just works out to be a difference of $20 or $40 in a year. So is that a lot? That's something that you could only answer. All I'm saying is that don't get overly bogged down on all these minor details when you want to get started. Now, comparing costs are already considered relatively easy. The hardest question that I've seen being kind of tossed around is how do you kind of judge them by their performance? Now, to be honest with you, I do not have a very good answer for beginners. The reason why is that to be able to appreciate the different approaches by each robo-advisor, you would have to have an understanding of what that investment approach is and then develop a preference for either one of them. Now, in my humble opinion, I think that for beginners, all you need to do is look for a robo-advisor that can build you a well-diversified portfolio. When you start to go and read their investment methods, it should just make some common sense to you. And as long as you feel comfortable with it, commit to it for at least 1 year and judge the overall experience of using that robo-advisor. What you should not be doing is trying to do a month-on-month comparison like, hey, my robo-advisor A made 10% last month, robo-advisor B made only 5%, therefore A must be better. The next question about money is how safe is your money? The good news is that most, if not all, of these robo-advisors are usually licensed. Also, your funds tend to be stored in what you call custodian accounts, which is usually just a bank account under your own name, which is separate from the funds of the robo-advisor itself. So in the event that the robo-advisor either closes shop, gets bought over, or runs into trouble, your money is technically isolated and it's in your own name, so your assets are therefore protected. It's very easy to double check this. All you need to do is go to the website of any of the robo-advisors and try and look under security or maybe search for custodian. One more thing about money is to double check how much it costs you to get started. With some robo-advisors, you can start from as little as $0. But for some others, for example like Endowers, you'll need about $10,000 to start a portfolio. Now finally, here are some considerations of how you manage your robo-advisor. Most will allow you to create as many portfolios as you want. The purpose behind this is to help you plan for multiple goals. So for example, if you had a long-term retirement goal, you can afford to take greater risk. But say you are saving up for a wedding. you might want to choose something else that is a little bit safer. Next, I personally don't think there's an issue when it comes to using multiple robo-advisors. I personally use 4, and they're for all different reasons, but it's something that doesn't really bother me because I do not actively need to log in every time. Every now and then I might check it out. Next is the question of contributing cash to it. So the question becomes, how often should you do it? Most of them will allow you a system of automation, so you should take advantage of that. When it comes to monitoring your account, truthfully, robos are designed to make things super simple for you that you don't really need to pay any attention to it. You really shouldn't be changing anything in the short term unless something major changes in your life and suddenly you either need to readjust your risk profile or maybe add a new portfolio in there to manage different type of goals. My final piece of parting advice is to really just take it easy. The reality is most of these robo-advisors are making it very easy for you to start and it's equally easy for you to exit. So don't worry about making a mistake because usually it is very reversible. Have fun exploring the different offers or products that they have and then compare it with the needs that you have. That's the most important part. So I did my best by asking some friends of what are the subjects I should cover, but the reality is I'm very sure I missed out on some stuff. So if you have any additional questions, please feel free to leave it in the comments below and I'll do my very best to try and answer them. So I hope you found this useful, and if you did, I would really appreciate your support in hitting that like, subscribe, as well as that bell button, because I'm going to be back again next Sunday with a brand new video to help you get better with money. And until then, you take care and keep playing your own game.